Now let's go into something more serious.
Back in April 2020, oil prices went negative after the futures market had completely underestimated the collapse in demand, causing market participants to have to scramble to find places to unload all the oil that they'd purchased. Here in April 2026, the futures market is in danger of something similar, but in the opposite direction.
Yep, it's in severe backwardization, which is spot price. The price right now, if you go out and buy oil, is much, much, much higher than the future price of oil. That's backwardization, and it's a sign of very unhealthy market.
After market participants once again may be completely underestimating the collapse in supply. Fearing that might be the case, Dallas Federal Reserve went out and asked Texas oil industry veterans what they thought about what's going on in the oil situation, and what they found you're not going to like. There is a historic yet almost completely unappreciated disconnect between cash prices and futures market prices of petroleum. We never saw anything like this in the Gulf War in 1990. Nothing close.
The world is watching the wrong oil price. That's intentional. It's intentional that the mainstream media has been trained to only look at the future price of oil as the price of oil and never look at the cash or spot price. It's because the future price of oil, that can be manipulated endlessly. It's paper oil. You can just print as much paper as you want. And that's what we're doing right now to keep down the future price of oil. But the now, when someone needs oil right this second and they have to go out and pay for it, that price can't be manipulated, and that price is soaring.
Even in 2022 during the Ukraine invasion. It's gotten to be like there are two oil markets with seemingly little relationship from one to the other.
Yeah, this is like the difference between like future price and the spot price. See, it goes down a little bit at some points. It usually stay. Right now, it's way up there, more than $20 difference.
Now that has enormous implications, just starting with people's impressions of how everything is going, what the chances for real fallout in the real economy really are. If all you see is the futures price,
this is the futures price. This is the one I said right when the Iran war happened that they would not let the price of oil go above 100 for any consistent amount of time for like 2 months, because they can't. Because of the way derivative market works, the banks would go under if they allowed oil futures price to trade at like 130. Yeah, you'd have financial system like break apart. They can't. So they're manipulating the price of oil by half of it by statements on behalf of Trump and whatnot, from manipulating perception, and the other half of it by just selling paper oil, oil futures to keep the price down.
WTI or front month Brent, it looks like the entire energy marketplace is relatively optimistic.
The actual price, as you can see in this graph, is way up here. I mean, there have been oil traded for $210 per barrel. That has happened. There's been contracts for it. So when you hear that, and now you see the futures price at 100, something's very wrong.
Now, $96 a barrel WTI futures isn't exactly good, but it also isn't 130, which is what traders are paying for actual barrels today. But here's the thing. The real world is increasingly being forced toward the spot price rather.
This is the important thing. This is the reason I had to watch this video in multiple point. That orange is gas. Gas prices basically in the United States. And if you notice, it headed up with the oil futures, and then now it's headed up. One thing to remember is the difference between oil futures and cash prices, that didn't start diverging until just about a few weeks ago, until this point. That's where it really broke apart, and the spot market, cash prices soared. And gasoline started following that. So, and it'll continue following that. So we're going to keep seeing gasoline prices rise over the next at least week or two, for no matter what, more like the next month or two, right into the summer.
Than the futures price. Just look at gasoline. Wholesale gasoline in the U.S. just hit a new multi-year high, and over the past couple of weeks, it's really started to diverge from WTI futures, moving in the direction of cash real-world petroleum costs.
Exactly.
And if or when retail pump prices begin to reflect the other oil market that no one's paying attention to, at least not right now, the entire
$6 oil is on its way. Sorry. $6 gas is on its way. Just in time for the summer. Look forward to it.
perception of the situation will flip drastically. So, Steve, we got a lot of stuff going on in energy, of course, as people know, but I think there's a lot of misconceptions and understandable misconceptions about what's really taking place here, because it really does start with the fact that the closure of Hormuz has locked up an incomprehensible level of supply. I think that's the part that's really underappreciated, if not completely unappreciated. The amount of
and you have Ukraine trying its hardest to damage Russia's oil production capacity too. So far they haven't really been able to yet, but they keep sending drones every few days. Eventually, they might take some $1 million of oil off the market, and that'd be great, I'm sure, for everyone who imports oil.
Supply that has been taken off the market is staggering, beyond comprehensive. So the answer, the question here is, what do we look at as far as assessing what that's going to do to the global economy and beyond?
Yeah, that is a real question, Jeff, because we look out through in the past and we can say, hey, 4 out of the last 5 recessions were all energy shocks. So if you're long the market right now and say, hey, I think it's going to go higher.
I'll repeat that. 4 out of the past 5 recessions were energy shocks. And now we've just entered the mother of all energy shocks. We're heading for a recession with rising prices, and that has a name. It's called stagflation. And most, like half of people alive today, more than half, have never experienced it. It sucks, trust me. Ask someone who did experience it.
Then you know at some point it's going to reverse. And if you're actually kind of de-risked during the last drop in the market, and you're like, I don't want to play chase, but is this thing got some legs where I need to, or is this thing about to drop off? Because that's the real risk. We know the longer energy prices stay up, we know that consumers cannot afford them. Now, in the short run, we do know tax checks are higher. It's helping offset some of this. But over time, the longer the shock goes, consumer spending has to drop. And then you couple it with the fact that, what are we hearing from the factory sector right now? Hey, it's booming, but it's booming because we're inventory building. And that's a huge red flag. So once again, we're front running things. We're building up inventory, and we're trying to look out and say, hey, how can we time this as the market's going up? Because we know the odds are high that we're going to get a recession, perhaps a crisis, and we know the equity markets are going to come down. The problem is, Jeff, we look at the equity markets right now, and it's at all-time highs and continuing to go higher. And yet you're hearing all over everyone around the world, central bankers, you're hearing investment banks, analysts, the pros are all saying this can't last. But the reality is, for the short term, it is. And yet, I think that's the real question here is, how long can consumers go? And right now, we're not seeing any cracks. We're hearing complaints, but the spending hasn't dropped off yet.
That's the point, right, Steve? It's how sticky the oil shock will end up being. I hate to use that term because it's overused by economists, but that's really the issue, is how long will oil prices linger around closer to the cash price rather than the futures price? And we'll talk about in a minute why there's such a difference there. But that's the issue. Like you said, Steve, in the short run, we've got a couple of positives, a couple of tailwinds, one of them being in the United States anyway. You've got the tax refund payments, which are right now, a lot of the studies, and including the retail sales data itself from the month of March, suggest that a lot of the tax refunds are simply going right into the gasoline station. Consumers are using the money to pay for the higher pump prices, which means they haven't necessarily cut back on their spending, especially discretionary spending, just yet. But then again,
any boost to the economy from tax refunds, that's gone right into the gas pump.
You got the data from S&P Global, especially outside the United States, which suggested that service providers in particular are saying, uh-oh, it's coming. It may already be happening in places like Europe, where the services PMI for S&P Global hit a 62-month low. But a lot of other services providers here in the United States said, we can feel the winds shifting. We can feel the consumer winds blowing. So it really is critical to get a handle on this energy shock and how sticky it is, which brings me back to what I talked about in the introduction here, the Dallas Fed survey. So the Dallas Fed survey, which was released on Thursday, was data collected between April 15th and 20th, so relatively recent. They surveyed 120 oil and gas firms, and of those respondents, 78 of them were in exploration and production, which is relevant here, and 42 of them were oil field services firms. So relevant experience in the industry. And the major question that they asked was, by when do you expect traffic through the Strait of Hormuz to return to normal levels? 20% said May, that's the most optimistic, so 1 out of 5, but 39% said August, and another 40% said either November or later than November. So at the very least, you've got the vast majority saying summertime at the early.
August, return to normal. It takes it takes time, even after if there's an agreement between Iran and United States to end the conflict. Bringing production back online is damage. Oil wells had to be shut down because they couldn't pump oil, and when that situation needs to be shut down, and they need weeks, if not months, to restart. So I'd say May is completely off the table. Even if there was an agreement between Trump and Iran right now, getting everything up to by May is impossible. August, if right now there was an agreement, that's possible. But getting an agreement right now, that is not going to happen. So my think November might be a reasonable bet, or these two categories, these two last. This one is the less optimistic. This one is the more optimistic scenario. These two, just no realistic chance. But November things might be mostly back to normal by November. Yeah, that's possible.
And when you couple that with the fact that the level of supply that has been taken off the global marketplace is absolutely astronomical, to not be able to restore that until summertime at maybe the earliest, it is going to be a much stickier oil situation than I think most people are appreciating, certainly at the stock market. Though, Steve, you and I talked about this, and I know you talk about this all the time in your show. We fully expected the stock market to behave like this. We said it a couple.
The price of oil will fall back to 65 per barrel level very quickly once the conflict settles down. That is no way that's happening. You have to understand, all the countries around the world, including the United States, have been releasing oil from their strategic reserves. And once the crisis ends, you know what they have to do? They need to put oil back into those strategic reserves. That means there's extra demand. And until that happens, you can't have oil go back all the way down to 65.
A couple weeks ago, it's going to rocket higher, and it has rocketed higher. But moving forward from here, unless the oil situation and the energy shock really does die down, and there is a legitimate solution to it, it's going to be more difficult for the stock market in particular to sustain its advance, given what it's been doing more recently. What is a Eurodollar University membership? It's where understanding the monetary you and prehensibility until to
say some. Yeah, absolutely right, Jeff. Because we look at it. I would say I think somewhere between maybe August and the end of the year is actually a fair assumption of what's going to happen. But even if flows came back, and I think a lot of people don't understand this. This isn't you just like your faucet where you just go turn it back on and everything just starts flowing. It's just because there's flows going to resume. They're not going to be at full strength. It's going to take time. In some cases, things will come back relatively quickly. Other things will take months. And there will be things that take years. Some things, they won't come back the longer this goes because shut-ins are a real issue. But again, you come back to the market. On April 1st, Jeff, I told all my subscribers on my show, I told my clients, I reallocated all the portfolios. Said, look, you have to go long here. I went long because it's not about the fundamentals. It's about more systematic positioning. Because the risk here isn't that the market goes up. The risk is and you nailed it. It's when does it come back down? And we know the longer the stretch is on, that consumers, they can absorb this. And we've talked about this in the past. In a healthy economy, consumers can absorb energy shocks. Now we know the economy is not healthy. We've laid out that case over the years that it's on a downward trend. But you give people, I think the tax checks are, from what I said, about $300 more than normal. Now, and
just have a look at the Dow. You have the biggest oil shock the world has ever experienced, and you have the Dow practically hitting new highs. It's insane. It's I will also just a famous quote right now. Markets can remain irrational longer than you can remain solvent. So this isn't my advice to go out and short the market. However, if you're long, I would look very carefully at what you're long in the stock market and consider right now a wonderful opportunity to sell. Most things, unless it's energy stocks or maybe weapons manufacturers, I would consider maybe reducing my holdings of most other stocks, because consumers are going to get hammered by $6 gasoline prices over the summer. And you have also AI layoffs on top of that. You have the layoffs that are going to result from companies going under because of the oil shock in general. It's going to be bad. You're going to have stagflation. The market will be going down at some point over the next 6 months. That's pretty much certain.
I'll tell you, Jeff, I really thought that if the economy was as bad as consumers have been saying in the sentiment surveys, that they were going to save and use it to pay down debt. And I was shocked as I watched the retail numbers. And I'm like, well, there's the market. That's why it's going to go up.
Something's not
because
right.
consumers are
Yep.
spending this. So what it tells us is, these tax checks can buy a couple of months, but you start to get out, middle of August, and we already are hearing from, consumers saying, look, I'm not going to travel. Why? Gas prices too high. Airfare's too high. I'm not going to buy a new home. Why? Not confident about my job.
Yeah, I am one of those who's not traveling this summer. I probably would have if the Iran war hadn't happened. I would have done one trip this summer, but not happening then now. Don't want to worry about canceled flights because of gas shortages. No, thank you.
So as these things start to get a little bit bigger and consumers come back a little bit more, what's going to happen is, again, all these inventories are going to pile back up again. And we're back where we were before, facing another inventory recession, except this time it starts to look a lot like stagflation, where energy prices, and this is the big risk, where they don't come down because, the supply and demand dynamics have changed so much that supply has dropped off.
Yeah, normally during a recession, gas prices fall because less demand, the economy is slowing down. But when you have an oil shock, that doesn't happen. You have gas prices go up at the same time as you have people losing their job. It's the worst. It's stagflation.
That maybe we have inflation, or at least energy prices, that stay elevated. At the same time, perhaps we start to see the labor market weakening. That is the biggest risk I think the economy and the markets are facing. I think people see it coming, where the markets are saying, we don't really care right now.
Well, I think, Steve, isn't it one of those situations where certainly investors in the stock market, but just people who are paying attention, they hear this, right? I mean, we've said it, other people have said it. Look, this energy shock is going to stick around for a long time. I think people hear that, it makes sense, but they don't necessarily buy into it.
Yeah, you have entire class of people, Trump included, the deep state, that, again, they can't have large, unpredictable swings in markets because of the way derivatives work and the financial system. So yes, in a legitimate market, stock prices would be down here. Oil prices would be $30 higher than the futures currently are. Yeah, that would be, but no, it's being manipulated. And this has as much to do with derivatives as the oil futures being around 100. That also has to do with derivatives. Oh, thanks for the follow. And for some reason, I don't see notification, but all right. Anyway, it's but whenever this happens, and I've watched it happen several times, where basically delaying the inevitable, like oil prices going up, stock market going down, it will go down, and it will go down sharply. Probably maybe another month. It depends. I don't know the inside of how long they need to prop it up for, and how long it takes them to reposition big banks to reposition themselves in derivative markets for a fall. But once they finish repositioning themselves, then suddenly you're going to have the media. You'll see it. You'll notice it when it starts happening. The entire media will start turning negative about stocks at the same time, and stock prices will plummet. And they'll start talking about, like, oil will explode upwards at the same time. And you'll be able to tell by the shift that, yes, now they're not manipulating stuff. They are not holding it up, and all hell will break loose. But we're not there yet.
Because, again, that the spread between oil prices in the real economy and futures prices, right? Yes, $100 per barrel oil is not good, but it certainly isn't $130 per barrel oil. And so the real economy right now is paying $130, but people's perceptions are being driven by, WTI, the front month contract, which is $96, $95 per barrel. So it's pretty high, but it's not extreme. And so you keep talking about this thing is going to linger on for a long time. The amount of oil that's being lost in the marketplace in the real physical marketplace is absolutely staggering. But yet WTI seems to be hanging in around $95 per barrel. So there's a disconnect there in perception. And so
it's so insane. The biggest oil shock in history, and stock hit record highs.
I think feeds into a lot of the more, and by the way, Steve and I will talk about this in a second. We think that's intentional. It feeds into this idea that the oil market is saying, it looks like the oil market is saying, yes, people talk about all this stuff. It's going to last a long time. But if we believed it, then the oil price would be a lot higher than it is. Therefore, the oil market must be telling us we are in the most optimistic case.
Yes, that's what they're trying to convey with these low futures. Or it could be just manipulated, and we actually are fucked, and it's government trying to put a lid on stuff for a while. So banks don't go under because of all their nonsense in the derivative options with puts and calls. I'm not going into details into why the market can't have really sharp swings, but it has to do with puts and calls. It is people that makes bet that the price of oil will be above 130 at X time in the future, and or the price of the Dow will be below, like let's say 4,500 at this point in future. And if it's below that, then financial institutions lose millions, so if not billions. And as long as they manipulate the market so that doesn't happen, then banks make a small profit. It's insane. But yeah, if you're wondering why U.S. markets don't behave normally in times like this, it's the derivative exposure of large banks.
And so I think that's the major misconception here, is that when you just look at the oil price that's put up there on the screen on, or thrown around on X or social media, it's not the one that necessarily represents the situation that we are confronting. It's sort of manipulated. And I think manipulate is the right term here.
It is.
Because you got to give the Trump administration credit. Set aside your politics. What the Trump administration has been doing to manipulate the futures price of oil has been.
You're giving too much credit for the Trump administration. This is the Fed, the Exchange Stabilization Fund, and the Fed, U.S. monetary authorities. They're the ones that have long experience doing this. And Trump is participating, or they're manipulating him into making these statements that manipulate the market. Or he's doing it voluntarily. I don't know. But they're the ones that are really handling stuff. The mainstream media is part of this. And they've done it so many times before. Like in 2009, despite U.S. having a terrible harvest, they manipulated the world into thinking everything was fine in agricultural markets, and kept the price of foodstuffs down 6 months. And then we had an explosion, like wheat nearly doubled in value, stuff like that, and riots around the world. Manipulation has been going on for a long time.
And nothing short of I want to say genius, because that's exactly what it is. So it leads to this misconception where the oil market appears to be saying, or appears to be pricing, the best case scenario. Meanwhile, the marketplace itself over here is saying, holy crap, this thing is building and building and building and building. It's not getting better. It's not likely to get better anytime soon. But yet $95 per barrel WTI futures, it looks like best case scenario, right, Steve?
Yeah, Jeff. And in fact, I would argue that it probably is very much the best case scenario. And, if someone's looking at the U.S. equity market and looking at the U.S. economy and trying to say, hey, maybe this is going to be okay, you almost have to, at this point, take the entire U.S. market out of the picture and start looking at Europe and Asia, because they didn't have these tax refund checks. So consumers are.
I just want to show you this. This is historical price of wheat. And what I was talking about, the manipulated price, is 2009, a horrible, horrible harvest in the United States. And we knew there was this horrible harvest mid-year, like June. There's all these stories. I was blogging about it, talking about like USDA has declared like most of America to be an agricultural disaster area. Yet, despite that, food prices fell. And it wasn't until 2010 where finally that shortage, the fall harvest in 2009, was a lot smaller. So you had food prices go, like wheat go from $3 to $8 in 1 year. And that was a 2010 food crisis. And you had riots in all types of places. I think the most famous of them was Egypt. Those riots in Egypt they were the result of manipulation. If you had a functioning market right here in June, see if yes, I can zoom in. We had a functioning market right here in 2009, like June. You see how it's going up here? It went up right here, this little bit. That was when all these news of disasters happened. And of course, the right thing to do, if you know you're going to have a smaller harvest, food prices go up right away. That reduces consumption. And food prices would have gone like this. They would have, in a normal market, like this, gone up at the news of bad harvest and then go this way. But instead, the media, the USDA, announced record harvests. That scared everyone, and media went along with that, and so prices fell hugely. And then, of course, reality comes in and pushes them up. This entire thing was market manipulation. Market manipulation. First, them pushing the price down, and then it returning to where it should be. In a functioning market, this would have been straight here. Bad harvest, prices slowly go up, and that's the way it should have worked. But we don't have a functioning system financially or in the media.
Don't have extra money. And as you said, in the beginning of the show, is look at the services sector PMIs. I mean, everyone said they were going to lead the factory sector out of this mess, and then now all of a sudden they're the ones leading to the downturn. But it's all exactly what we've been talking about, Jeff, is, energy prices go up at the pump, your air conditioner, your electric bill, all that stuff, and you have to make a trade-off. So you start thinking about it. Consumers are making the trade-off on the services side, and on the factory side, everybody's front running because they're like, hey, maybe these energy prices are going to go up in the months to come. So I want to get as much inventory now, once again, while things are cheap. And that's driving the factory sector. But the PMIs are very interesting too, because they're like, hey, backlogs are dropping, inventories are rising, and we don't think this is sustainable. So if I was looking at where the global economy and the global markets are going, I'm looking at Asia and Europe right now. I mean, look, I belong to the U.S. market. I've been very clear about that. I do believe it goes higher, but my risk is, when does it reverse? That's why I'm watching the rest of the world, because
I would not be overly long U.S. stocks right now. We're heading towards a recession as a result of this Iran war and the oil shock, for certain. And stocks are going lower. Things are manipulated right now, but that manipulation doesn't last forever. They could manipulate it down temporarily, then reality catches up and prices shoot up. All this was the result of the overconsumption and not recognizing that we had a terrible harvest right here. USDA tricks the world into that we have an oversupply of food. Then the reality sets in that there's a drastic shortage and it skyrockets. A normal world, it would have just gone like this. This high wouldn't exist and this low wouldn't exist.
they think they're going to give us that indication far before everyone else. And if that happens, then oil prices are coming down. But once again, as we've talked about, just like interest rates, yes, everybody wants lower interest rates, but if they're going down, it's for the wrong reasons. I would argue the same thing. If oil prices started collapsing on the front month, it would tell us that there's something wrong in the economy that's going to drive them lower. It's a demand destruction issue.
Well, yeah, and I think the other thing that will correct that misperception, Steve, is right, the gasoline prices. So if gasoline really does start to reflect the cash price, which, by the way, again, dated Brent's around $130 per barrel, not the $100 per barrel that the futures price is at. If you have gasoline prices that start to diverge from the futures price in oil, people are going to stop paying attention to $95 WTI.
Plastic prices surged 70% on supply shortage. Yep. Its prices are going up in everything because everything needs to be moved with fuel on trucks, on boats. Next year, you're going to have food inflation to factor in on top of that. We're heading for a long period of stagflation.
WTI futures and start saying, what the hell's going on with gasoline? Why is it, rising? RBOB, which is the main wholesale future gasoline price or gasoline price future, that one has moved to a new high, new multi-year high. It hasn't been this high since the energy shock in 2022. Even though oil prices are hanging in, RBOB is creeping higher. It's up around $3.45 per gallon, which is an enormous price. Again, that's wholesale. Then you got to add taxes and everything else on top of it to get to the retail price, which is going to be around $4.50, heading toward $5 per gallon. So as the gasoline price starts to reflect the cash price, the idea that the best case scenario is being priced into the marketplace is probably going to disappear relatively quickly. And then as Steve said,
I think the final oil price, in some places in the United States, it'll be over $6. Some places it'll be under $6, like 5 something over the summer is my personal opinion.
You're long in the stock market, then you have to make some tough choices because then the world starts to look very differently. Then it's not, hey, the oil market is relatively sanguine in pricing the best case scenario. It's holy crap, gasoline prices are pricing something else that we weren't anticipating, even though you should have anticipated this the entire time, given the scale of supply disruption. And let's talk about that for a second too, Steve. The reason why WTI futures and Brent futures, for that matter, are diverging so much from the cash price. Look, every time the futures price goes up, President Trump, and again, this is definitely intentional. Every time the futures price goes up, there is a tweet or a Truth Social that comes out that says,
when I say some people are thinking that, Trump is manipulating the market, but I very easily see a situation where it's also Trump being manipulated. You have the Secretary of Treasury comes in, if we don't get oil futures down, the financial system could crash. I mean, you had during 2008 financial crisis, when they were asking Congress to pass this bank bailout bill, they told Congress, "Oh, the financial system will crash if you don't do this." And yeah, you can get politicians to do nearly anything if you tell them that. Like, the world depends. We need to get futures down, or X and Y bank is going to fail. You tell that to Trump, and Trump will put out the tweet you want. So people saying, though, it's Trump getting rich off of this. Perhaps some people around him, those less honest, might be using insider trading to make some money. But I think overall, it's to prevent losses, to huge losses to banks in derivative markets, that all this manipulation is being done. And the extent where Trump really understands what's going on, or the extent that it's just his Secretary of Treasury telling him to do this or that, I think that's more likely just him being manipulated by Secretary of Treasury, and then his tweets being used to manipulate the market.
Going to talk to Iran tomorrow, or we're doing something about getting things going. And because everybody is leveraged so much in the futures market, the downside to being long in that type of news flow risk.
Oil trader Aduran lost 52% in April first half on oil bets. Yeah, it's that thing. When this huge shift in the oil markets, the losses had to go somewhere. And if you go to banks, if let's say Trump doesn't manipulate the market, and let's say this oil trader, he bets that oil will go up to 150 and it doesn't, well, let's say it does, because Trump doesn't manipulate the market. It does go up to 150, and this guy makes a lot of money. Who's losing that money? Banks, financial system. They need to be taken over by the FTC. Huge cost to taxpayer, undermines confidence in the United States and its financial system. It's a disaster. So Trump and the Treasury markets and the media all cooperate to hold oil at 100. It's the trader that takes this 52% loss, and the banks don't lose the money. And so that's how it works. That's why insiders, the 1%, keep on getting richer, is that even smart people that assume the market is working honestly and make bets based on that will lose money because the market's manipulated. And this happens at all levels. You have big traders like this, and then you have small retail investors who look at situations and, oh, oil's going up to 150 and make bets, and then they lose money. Because anyone assuming the system is honest gets screwed. You have to know that it's manipulated to have any shot of not losing tons of money.
Scenario is absolutely immense. Let me give you an example here. There was a story that showed up in Bloomberg late this week. In fact, it was just a couple of days ago. Energy trader Pierre Andoran's largest hedge fund plunged about 52% in the first half of April, wiping out first quarter gains made on bullish oil bets at the start of the Iran war. His fund slumped this month through April 17th and is now down almost 37% for the year. A person with knowledge of his return said, asking not to be identified. It comes after the Andoran Commodities Discretionary Enhanced Fund delivered a 31% gain in March, even as other hedge funds were caught off guard by the huge swings in commodity price.
Yeah, because he was probably betting oil would go up even more. And that would have been true in an honest market. And it's true in reality. The spot price of oil is now 140. But who would have been the losing side of these bets he was making? You probably would have had important players, banks, the deep state. And it's insane practices of banks to meddle in derivative markets for an extra source of cash. And they do it on the assumption that if things go really wrong in derivative markets, well, the U.S. will bail them out by manipulating the market. And it's true. That's what happens.
Prices and inflation expectations unleashed by the war. So this guy is massively leveraged long oil. And what it goes to show is that if you're on the wrong side of some kind of presidential tweet, you can get your butt handed to you. And that's a point that's reminded, or it's nailed home every single day in the marketplace. So if futures market has to reflect not just the upside from the fundamentals that we're talking about, but it also has to keep in mind the downside, because if the best case scenario would actually develop, there is a huge downside to oil prices. So yes, the futures price is being manipulated, which means that as
No, even if the conflict ended now, oil prices aren't going down for at least a month or two. It just it takes time for tankers start moving it around and for oil facilities to be put back online. It's even the best case scenario, oil futures are too low.
the longer this goes, the less accurate that becomes. And so you're looking at the wrong market price, and you should be looking at something like the cash prices or now gasoline.
And Jeff, the same thing is true with the stock market, because look what happened going into the the ceasefire where it was going to end. Everyone was like, okay, the market rallied, but now it's going to come crashing down. And people are like, all right, I'm going to go back and start shorting here. But if you look at the underlying data, we see retail investors didn't participate in this rally going back to April. We saw a lot of professional money managers were building cash, and then hedge funds were short as they were going back to Liberation Day. Now, back then they flipped and went long. This time they didn't. They're still almost the same level of short positions. So you want the market to go up? Simple. You just got to squeeze them. And so I know people are, saying, hey, you should close your lungs, close your lungs. I'm like, nope. And sure enough, the next day the market dropped, and I know people are like, ah, ha, ha. And then Trump came out with a tweet, and it was like, yeah, we now have a 3-week extension and maybe an indefinite, who knows? And boom, the market now, Friday, all-time highs. Once again, it's like, look, they know that the dynamic to pushing the economy through, because, nobody knows how long this is going to go. But if you don't think there's someone in the Trump administration, Jeff, and I know this is true, that's telling them, look, if this energy shock persists, you're going to get a recession. This is not what you want. So what do you've got to do? You've got to talk oil prices down, and you've got to talk the stock market up to keep people that are in the market making money, because they'll keep spending, and maybe it'll keep things going. It might not, but that is the short-term effect. So yes, is the oil market being manipulated? Yes. Is the stock market being manipulated? Yes. And are people that are short going to get squeezed to the upside on the market? Yes. And those long on the oil are going to get squeezed to the downside? You bet. And if you don't think it's happening, kick back and watch, because we're seeing it happen right now in real time.
It's a smart political play, right? I mean, if you're the president at this point, what else are you going to do? You've decided the Iran conflict must be worth the political capital. Therefore, you've got to do whatever you can to see it through. And yes, stocks want to go up. They want to go up. So leverage that trend. Oil prices need to go down, because fundamentally, you take away the Iran conflict, oil is $50 per barrel, not 150. So leverage that too. The problem for us, as Steve is pointing out,
without the Iran war, oil is 60, not 50. Just
here, you want to chase the stock market returns, but understanding that if this oil shock does stick around past a certain threshold, which you cannot predict ahead of time, it is going to lead to really negative and nasty consequences. And so as we go further along here, you want to pay less attention to the manipulated prices and more attention to the fundamental values, which are unfortunately not stacking up in our favor, which brings us back to what we said earlier with the Dallas Fed survey. The oil shock, from at least from this perspective among oil veterans, looks to be a lot stickier than people are giving it credit for. And one reason for that is because the amount of supply...
We're now 2 months, basically. We're April 28th. 2 months, the Strait of Hormuz closed. By far already, even if it opened today, the biggest oil shock in history. Oil prices need to be higher, and stocks hitting an all-time high is just insane.
Being constrained is absolutely staggeringly huge, astronomical, whatever term you want to put into it. And the longer it goes, the more likely not only leads to that worst case scenario, some of the bad scenarios, it leads to more permanent damage. Therefore, even stickier on the oil shock. So our recommendation here is, look, you got to understand what the energy shock is and where it's going, what's going on behind the scenes, which means more and more you got to pay less attention to the futures prices and more attention to other prices. And they're starting to make some moves that look like the downside is really starting to build up here.
Absolutely. And Trump is still talking about victory in Iran. That's my litmus test. Once he stops talking about that, once he's given up on presenting the Iran war as a victory for himself, then you can actually have severe, real negotiations where the U.S. has concessions, does the concessions needed to get Iran to open the Strait of Hormuz. We are nowhere near that. So probably like a month after Trump stops talking about victory, you might have an agreement. And I'd say it's another 2 months before Trump gives. So I'd say 3 months is, I think 3-4 months is when we might actually see an agreement. And the Strait of Hormuz will actually open. That's going to be devastating for the economy, world economy. And stocks will not keep on hitting all-time highs. They might for a while, but it's manipulated. And like I showed you here, you already had at this point in time knowledge that the harvest in 2009 in the fall would be a disaster. And they managed to trick the price of wheat to nearly fall by half. But they can't, there's a limit to how long they can manipulate the markets like this, because reality sets in and prices in the long run go up to where they need to be. Oil is different than food. Food is, you have yearly harvests, and so it takes, prices adjust slower. Fuel is consumed immediately, and I expect the time frame where it can be manipulated is a lot shorter. Like, it's already reached a point where the spot price has gone above the futures. So we're already reaching basically the limits of manipulation right now. You have another month maybe of manipulating futures. Either futures go up, or the gap between reality and the futures will grow even further. Anyway, this will be on YouTube. Like and subscribe. Come watch our Twitch, and I'll see you next video. Bye.